Make sure you set rules to follow and make sure somebody is helping you with this stuff and you really follow. It's here to not only protect the investor first and foremost, but also to protect you and make sure there's guardrails in place that you don't get yourself into trouble or you bite more than you're supposed to. So wire always goes to the title company, unless, let's say, if somebody's investing in our fund, then they wouldn't. It's a little different structure of private money and then investing in a fund, right? A fund, you are buying securities from a company, which is the fund, and the fund buy the assets. So you would, in that case, you would wire to a special account that the limited partners control on the fund, and then the fund would purchase the asset. But in this case here, if you're doing a private loan, you want the investor to wire it to the title company, not to you directly. Okay. You want to provide them the entity docs that are going to be the borrower. You want to have clear instructions on what's next. This is when the funds. This is what we need to buy. This is the type of information that I need. You got to disclose everything. Always protect the investor. If you're doing a structure, or if you're doing a rehab or a remodel, you always want to have hazard insurance. If you're doing construction, definitely builder's risk. You want the lender to be listed as a first loss payee. In case of any loss, they get paid first so they can recoup their investments. All liens get recorded by the county. Some people like filing UCC liens, which is commercial liens. I don't think it's necessary, but some lenders like doing that. But on the county level alone, you're more than protected. Always get a lender title commitment and policy. We'll go over that in detail. One of these months, I'm going to do some private lending case studies on how we deploy money and how we do the whole borrower due diligence, collateral due diligence, how we structure the paperwork, things we do and don't on purpose, and their own system that we've developed over the years. Okay. I always get a CPL, which is a closing protection letter, that this ensures the closing for your lender, saying, hey, I'm going to be in this position and these conditions have to be met before the deal is funded. So this is what protects that. Whatever title. So different title companies use different plans for underwriting the title and the insurance. Chicago, West Core, there are so many of them. You want to know and make sure it's a solid underwriter that's insuring that. In case you got to have a claim, you got to make sure they have, they can cover it. Provide investors with data room, all the third-party reports, amortization schedules, warranty deed, all that type of stuff. It's very important. So, deal execution is not what you do, it's how you do it. Excuse me. So let's talk more about this deal here. That wasn't the deal. That was a different slide. So how did we do it? We sold it as is, seller finance on a wrap around lien. We sold it to an owner finance buyer. Part 1, which is 4111. This is back. No, it's not. It's right. It's correct. So part 1, 4111 and 4109 West Virginia. We sold it for $49,495. We collected $500 down payment. We charged $295 doc prep fee. Remember, we drafted our own paperwork. And then this is how much the borrower, the buyer, pays us every month. $461.36. We did this on a 20-year term and amortization, which is 240 months, at a 9.5% interest rate. The date that it closed was March 18th, 2022. if we had this loan stay for 20 years at 461.36, that would be a lifetime value of $110,726.40, in which for 20 years it is $5,536 a year. Okay, this is what this means. Let's play with this stuff now. See, everything is organized here by buyer of 4111. So under the, we do our own docs, guys. I don't recommend you do that if you don't know what you're doing. And we are a licensed loan officer as well. So we have a mortgage company. So we are able to use that licensing towards that umbrella. So a lot of this stuff that we do it so often that we integrate with our process. So it makes it very efficient and very cost effective. But this is the borrower docs, like everything we collect, like a 1003 application, social security, driver's license. You just like a lender, you have your own process that you follow. I won't have time to go into every detail on this deal because we're almost an hour in, but I will do it in another case study that we do a deal like this, and I'll show you. But what that means is the loan schedule is we always have a third-party loan servicer services the loan. For this one, it was a few years back, so we were doing it ourselves on the software. But this is what it means that it means that we are the bank, right? So the buyer is just like if he was getting a mortgage, he would pay the bank. On a seller finance deal, you are the bank. So they are making the payments to you. So this is what that looks like on a contract for a seller finance transaction. I'm going to include all of this in the show notes. I just had to redact some of the personal information from the borrower to make sure that their information is not publicly displayed. But I will include everything, the addendums that we use, how we structure it. This is what I was saying, the 240 payments, the schedule amortization. This tells you how the principal and the interest is applied towards the loan every month. So that's why usually a loan servicer will be in charge of this. And let's say if she prepaid early or in May, then I would know this is how much the principal is due. So very important to have this document. That's what that meant when I said the schedule amortization. Also, this is what a warranty deed with vendor's lien looks like. Since it's a seller finance, it says vendor's lien reserved to grantor, meaning seller finance. There's also, if you remember, this is a wraparound lien. We talked about this earlier. My underlying lien that was recorded from my private lender, it's staying in place. He's still protected. He's still in first position. And I disclose all of that into our closing documents. I get consent from the lender, and I have to disclose it to the buyer that this is a wraparound transaction. Everything is in writing, and everything is disclosed on your warranty deed, on your deed of trust, and on your promissory note. So everybody knows what's going on. We're not hiding anything. We make sure there's no due on sale clause. And how a lot of people do this wrong, if depending what type of underlying lien, if it's an agency loan or if it's a government loan like an FHA, and the lenders are starting to call stuff due when you do it and you don't disclose properly, and there's a due on sale clause. So we make sure that none of that is going to be triggered, or if it is triggered, we have ways of solving that, and we can get into that a little bit more. But on the deed of trust, is going to have right here prior lien.